Hi everyone, thanks for watching. This is Steve Shaw, founder and president of BondSavvy. There have been two key areas that have been dominating the discussion when it comes to bond investing over the last several years. The first is passive investing and how prevalent that's become. And the next is whether or not there is a so-called bond bubble. And I would say those two concepts go hand in hand in that the more that you engage in passive investing, the more you are buying bonds at very high prices and into a potential bubble. Because when you can't select the price at which you buy something, you're potentially buying something at a really bad price. And that's unfortunately what happens when you buy bond funds and ETFs. And that's what this video is all about. So let's get going. On slide 2, what I show here is recent search results. Recent search results for corporate bonds. And this was done back in December, and it included 1,963 investment grade corporate bonds. So those are the bonds that are more highly rated. So those are bonds that are rated BBB minus and above. So those could be, run the range from Apple, Microsoft at the high end to Kroger, Walmart, those kind of guys. Those would be investment grade bonds. And you see what the distribution of the pricing is. You see how it is, at the low end, it's 80. And at the high end, it's 150. So what these prices represent is when a bond is quoted, it's quoted as a percentage of its face value. The face value of a bond is $1,000. So if a bond is quoted at, say, 90, that means 90% of $1,000 or $900. You'll see that of the 1,963 bonds, the biggest group are bonds that trade between par and a little south of 110. That's 38% of the bonds, or 742. What's more telling is the bonds that trade at a significant premium. So 52% of the bonds that came out in this search were trading at a significant premium. And what I mean is you have bonds that are trading north or equal to 110. So when you buy a bond at, say, 125, that's a significant premium to par. You see that bonds don't go up to 200, right? The highest they can go up is maybe they go up into the 150s. That's generally as high as they can go, but it's very it's few and far between that make it to that point. And the reason why I mention that is that if you buy a bond fund, those bond funds have hundreds, if not thousands, of bonds in them. And since you're buying the market, since most of the market is priced above par, that's what you're buying. So you're buying lots of bonds at 125, at 135, at 140, at 115, all those prices. And what that does is that limits your upside. Reduces and increases your downside, quite frankly. Compared to if you're able to buy bonds individually, you can then be selective at which price you buy them. So you can buy bonds at, say, 80 or 85 or 90 to 95. And you'll see that there are not a ton of bonds that are priced at a discount, but 170, so about 10%. And that's what I do when I invest in corporate bonds, and that I'm looking for bonds that trade at a discount to buy a bond at, say, 85 that can trade up to 105, and all of a sudden you've not only received your interest payments from the issuer, but you've received potentially a very significant amount of capital appreciation. So of all the benefits of owning individual bonds, this is, I would say, the biggest one. You get to select the price that you're investing in. And now it's so important because you've got so many bonds that are trading at a premium. You need to be selective to maximize your returns. On to slide 3, and this shows the benefits of owning individual bonds. These are the investment grade bonds that I owned during 2017. You see, I own 5 investment grade corporate bonds, and these are not fly-by-night companies. This is Microsoft, Apple, Discovery Communications, and Jefferies. and returns. Who would ever thought that a Microsoft bond could return 17%? So that when I say return, that's a total return. So that includes capital appreciation plus the interest that I received. 17% on a Microsoft bond. Microsoft is one of 2 companies that are AAA rated. So the highest credit quality bond returned 17% last year. Jefferies, the investment bank, returned close to 20%. Now you look at what the iShares Ag did, up 3.5%. That's the largest bond ETF. But that's where all the hype is. People keep talking about these bond ETFs. But when you invest in bonds at a premium, which is what iShares Ag and the other big bond funds do, your returns are not going to be compelling. And that's shown out on this chart. Moving on to slide 4, and this is the reason. So this compares my returns. So my returns last year and 2016, those are in the green. So 15.1% on a blended basis, compared to 7.16% for the iShares LQD. That's the corporate bond iShares ETF, and then 3.5, right around 3.5% for iShares Ag and Vanguard Total Bond Market, which is the largest bond fund. And the reason for that is you look at the number of bonds that are held in all of these different funds. So iShares LQD has 1,876 bonds. You remember the previous couple slides, there were about 1,900 corporate bonds, investment grade corporate bonds that had a yield of 3.5% or more. Most of those bonds are trading at a premium. So when you buy iShares LQD, you're buying hundreds of bonds at a premium. And who wants to buy a bond at 135? You want to try to buy a bond for obviously as low a price as you possibly can to generate as strong a return as you possibly can. And also, apart from that problem, iShares Ag holds 12.5% in cash. And so immediately your returns are hurt by that because it's in cash. It's not owning any bonds whatsoever. So just to review, there are significant benefits of owning individual corporate bonds. You can be selective, you can drive higher returns, and you're not investing in any bond bubble that's created when you passively invest in a large fund. Thanks so much for watching. This is Steve Shaw. I hope you will subscribe to us on YouTube and follow us on Facebook, Twitter, and LinkedIn. And check us out on our website, bondsavvy.com, or email me at steve@bondsavvy.com. Thanks for watching.